why banks own billions of dollars in life insurance, and you should too. Banks own billions in life insurance, otherwise called BOLI, bank owned life insurance, because, for instance, the strategic reasons, including tax free growth, death benefits, funding employee benefits, deferred compensation plans, and acting as a high quality asset to fulfill Tier 1 capital requirements. BOLI, otherwise called bank owned life insurance policies, on key executives and board members also provide a vital safeguard against financial losses from unexpected death of a valuable employee. Okay, now let's dive into what we have here. Now, a tier one requirement, or specifically a tier one asset, is something that includes, as you just mentioned, life insurance and also real estate, depending on the type of real estate to be more specific. Okay, so a tier one asset is what they use to put most of their money into to secure more financial security for themselves. Okay. Now, the reason why they do that is because life insurance is considered a safe asset. Okay. In a couple of videos that I've made here, I've already mentioned how you can get anywhere from about 8 to 15% back of your money. But the main important thing that I want you to remember here is not just you're getting 8 to 15% back of your money each year, but you're also being protected from market volatility or downsides in the market. Okay. So you're not losing any money. Okay. So you might not be getting anywhere from about 25 to about 50%, which some people may promise you, but you're not even losing any of that money anyway. Okay. So your money is safe while you're still getting steady returns back on your investment. Okay. So not only are you getting what's called the death benefit, or the banks are not only getting the death benefit, but you're also getting compound growth based on what the policy and index the policy is growing on inside of it. Okay, so you're getting the death benefit, which can be worth anywhere from around, let's say it's on a key employee, anywhere from about 100K to anyway to some cases maybe like 2 million. Okay, and you're getting the compounded growth that maybe inside the policy, let's say around 50K at the same time. So what banks are doing is they're compounding their efforts. So they're getting a top employee. Okay, the employee is ranging or giving them anywhere from around, I don't know, let's say it's a top employee, top executive somewhere at a Fortune 500 company. The employee is bringing around 500K to about around $1 million for the company. Okay, if that employee were to pass away, what they would do is they take this death benefit. Sometimes, if it's a good bank or if it's a good employer or whatever, they might use some of this death benefit to pay for the funeral, or they might just recoup the entire death benefit. It is what it is. Okay, so they recoup all this money back into themselves, and they recoup this compound interest on the policy back into themselves because it's a tier one asset, and because it's a tier one asset, they have no opportunity of loss in the policy. So that's why they put a large sum or large percentage of their earnings into life insurance. Okay, now they also do a good amount of real estate as well, and the reason why they do that is because real estate again is an asset. They want to put money inside of assets to bring them more money. The purpose of money is not to first pay bills, not to first maintain good credit, but the purpose of money is to make more money. Okay. Now, banks, obviously, because they're a bank, they have to know how to make money. So the reason why they put it in a safe investment that gives them around 8 to 15%. Ooh, that 15 would look horrible. 8 to 15% back of their money. The reason why they do that is because they want safe, guaranteed, somewhat quick returns. Okay, so they have the death benefit, which range from anywhere from 100K to 2 million, and they also have compounded interest from around 8 to 15% per year, which it was on a top employee and they've been there for a while, and the company is putting in a good amount of money or investments in the premium every single month. Anywhere it can range from about 2 to 3 years to about 50K, easy, and that's just on the low end, easy. And so something were to happen, the bank is taking back in this death benefit, and they're also taking back in this cash value. Now, nothing has to happen for them to take back in the cash value. This cash value for the bank could be working capital for whatever they want to do. Okay. Now, imagine they have hundreds of employees that they're doing this with. Okay. If they have hundreds of employees that they're doing this with, you see why banks are putting money in this tier one asset, because it's a way for them to make more money. That's why they're a bank. Okay. All right. So this is part of the reason why banks own life insurance. Again, because it's a tier one asset, it's a safe investment, and it gives them steady rate of return year upon year, year upon year. And the more people that they have policies on, the more money that they make. Okay. Now imagine for yourself and for your own family, you had somewhat of a corporate structure yourself, a trust, preferably a common law trust, express trust, preferably. Okay. Now imagine you had this. You had an executive. Okay. Executive grantor. Okay. The executive grantor is the one who forms the trust. Then you had a trustee. Okay. Then you had beneficiary. Okay. That's a basic just a basic trust structure. Okay. Now imagine you had a family. Okay. Now in this family you have about 10 members who are part of this trust structure. Each member of the family has a life insurance policy on them that when something happens, it's going back to the trust. So the same thing that these banks are doing, your family has the opportunity to do. Okay. Have you ever heard of the Rockefellers? Heard of the Rothschilds? Ever heard of the Vanderbilts? Vandies? Okay. These families, other than being extremely wealthy, one thing they also did is they knew about the corporate or the private trust structure. And them knowing that, they know just simple ways they can tweak their money to make it more beneficial for them and for their families. Okay? So, with that being said, you now know why banks put money in a tier one asset called life insurance. And it should have sparked in your brain why you should start doing this for yourself. Take care.